Good morning, good morning, good morning. Hope everyone out there is doing well. Happy Taco Tuesday to those that celebrate this momentous occasion. I will be live in just about 4 minutes here at 9 a.m. Eastern sharp. All right, let's get this party started here. Good morning, everyone. It's me, Markets and Mayhem. We're going to talk about order flow using Bookmap to dive into futures and stocks this morning. But before we get started, we're going to go right through everyone's favorite part of the presentation, the general disclosure. All Bookmap limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Trading futures, equities, and digital currencies involves a substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. So let's get right into it here. I've got Bookmap on screen, as you can see. We got the S&P futures contract for September. Just saw a large iceberg come through, 500 sell iceberg into some of that buying pressure we just saw. I'm just going to tweak a few things on here, so give me 1 second. I just need that strength to have a higher threshold because it's a little low for me here. All right, that's fixed. So biggest thing here that's interesting is you see how there's liquidity hovering above and below spot price on ES. That's unusual to happen post-contract roll. We saw that yesterday. We're seeing it again today. And we're seeing it a bit in the NASDAQ as well as the Russell, but it's really pronounced in the S&P 500. So it's just a bit of a change in the market making dynamics that we would typically see in this contract. It's a little different than usual. So it's interesting. It's something that I think warrants our attention just for the reason that we are in a somewhat interesting um, dynamic right now. And that is that we're going to open a negative gamma. We've got a relatively thin order book, about 46,000 contract order book depth on ES, which is low. Yesterday's was low. It's a holiday shortened week. So on the one hand, you have a little bit of faster vol runoff, but on the other hand, you also have less liquidity, which can promote higher realized volatility during the trading day. Yesterday, we saw yields shoot up, continuing that move we saw on Friday. This is being attributed to a whole host of different origins. Some say that this has to do with both presidential candidates, as if somehow the debate made it clear that both are pro-asset inflation or pro-inflation in the sense they're both likely to be big deficit spenders. I don't think that's the catalyst. Personally, I look overseas to Japan, where they're likely to have to put up a formidable fight to defend not against a certain level in their currency, but a certain amount of volatility. And that's something that I think is a motivator for them to liquidate some of their Treasury holdings, particularly given that they're the largest foreign holder of those Treasuries. It matters. So I think that might be part of the catalyst. The other part of it is, of course, you do have a lack of term premium. It doesn't make a lot of sense to buy a 30-year bond when you get a 30-day bill with better yield and turn that paper over, in a month and buy more or buy something else. So you don't have that same risk of holding something for that period of time. Whereas with a 30-year bond, you're pretty much stuck to it unless you're willing to take a capital loss or, if you're lucky, a capital gain on trying to resell that paper. So there's no term premium there. That suggests yields could continue to move higher. That's actually part of our outlook when we look forward, that we think that yields could actually continue to push higher. The reason I mention that is there's a line on the sand with the 10-year yield at about 4.5%. We notice that when that sort of upward pressure in yield happens on the 10s, it tends to put some pressure on equities, particularly those that are more rate sensitive. And the Russell is one of those that is extremely rate sensitive. So we've seen that impact on the Russell as rates rise. The Russell tends to get walloped pretty hard, just like when rates drop, it tends to get a pretty decent bid. And you can look at the constituency of the index to get a sense as to why that might be the case. One reason, looking at the Russell, is about 30% of the stocks in it don't make money. And then you have the regionals, which have their loan books largely parked in various duration that's rate sensitive as well. So the reason I talk about that is intermarket dynamics are important. I like to track the way 10-year note futures are trading, particularly after event volatility catalysts, because often there are clues in that as to how other market dynamics can take shape. Yesterday's big rise in yields following on with Friday's seems to be putting some pressure on equities this morning as well. And that likely has to do with the fact that yesterday, some of that could have been offset by beginning of month and beginning of quarter flows, which are largely constructive. July seasonality for the last 15 years on the NASDAQ has also been positive, 15 years in a row. Tech stocks have rallied in July on the NASDAQ. So there is some optimism going into this month that it'll be the 16th year of the same. But nevertheless, with rates rising and some of the risks associated therewith, it's something to pay attention to. Another reason rates dropped was that we saw some degree of, let's say, resumption of the Immaculate disinflation soft landing scenario, and we're not necessarily sure that's going to take place. So that's something to take into consideration, because the headline misses on CPI and PPI were largely driven by gasoline. And if you look at gasoline prices for the month of June, they basically made up that entire drop, which suggests that you'll see headline creep back up, and that could put upward pressure on yields, downward pressure on equity. We're also set to open below the gamma flip level today, at least so far, with the way pre-market is behaving here. So S&P cash is implied to open around 54, 55.20, down about 0.36% right now. When I look at the S&P naive gamma model we have at Treasury, the gamma flip level is calculated at 54.71. So we're implied to open below gamma. What that means, if you backtest that, is that you're getting into a regime that promotes greater volatility and heightened downside risk. Similarly, positive gamma territory tends to promote lower volatility and I mean in realized terms rather than implied terms, because implied vol for the S&P almost means nothing when the average S&P stock trades at 4.5 times the realized vol as the index. But anyway, what it tells us is if you get into that negative gamma environment, dealers are more likely to sell dips and buy rips. That can exacerbate realized volatility to some degree. And then you add to it that we have a somewhat illiquid order book, and I think it could make for some interesting trading dynamics. And today's calendar will be interesting. We've got the Fed and Powell beginning a speaking session around 9:30 a.m. at market open. Then we've got U.S. Jolts job openings, which would typically come out tomorrow, but we've got that holiday shortened week, so we're kind of scrunching the data in, if you will. The expectation for Jolts is that it continues to move lower. The last reading was 8.059 million. Today's reading is expected to be 7.95 million, so dropping by another 100,000 jobs or so. This is an important event volatility catalyst given the illiquidity of the order book. The market likes to seek direction in that three-way auction. So the way I'd look at that, if we get a meaningful drop in Jolts that is beyond what's expected, that will be bullish for risk, and that could bring rates down. And the opposite would be true if Jolts comes in stronger than expected, materially so especially. You should see a continued push higher in rates and some de-risking continue, particularly in longer duration risk assets, like some of the non-mega cap techs and the small caps and otherwise. Now let's take a quick look over at crude oil here. Crude oil is something that I've had my eye on really because I felt like the drop we had was a little bit beyond what was warranted. And crude is one of those commodities that is so efficient at knocking people out, whether you're bullish or bearish. So I'm just going to pop this chart on screen real quick because we are in a very constructive period of time for crude, whether you're day trading it or swing trading it. And the reason I say that is everything that played out here was exactly what you wanted to see, to shake out weak hands and then bring back a bullish bias to the momentum. So we were trading in a range. We broke below that range. Pretty much every stop that could have been run was run in that breakdown. Once we got back into that trading range, that started to tell you, okay, we're back in a sort of consolidation, trading sideways auction over the longer time frame. And once we broke above that trading range, and particularly above 81.36, that's where crude became very constructive. You can see the momentum indicators on my screen also showing the same. It's now trading at 84.23 pre-market, and I think it has room higher to 85 and change as this month goes on. If we can break above that level and build acceptance, I think we can get back to the low 90s. But this is a constructive time of year for crude. You see a lot of people traveling right now. Airlines are talking about record traveling TSA, record travel screening. So that's one of the reasons that crude was buyable on these dips. But the opportunity now, in my opinion, isn't as much in oil as we're saying, okay, well, maybe it's got $1.50 left on the upside in the near term. My view is the opportunity in the near term is actually in the energy companies that have underperformed oil, where their valuations are very attractive versus the broader market, and they have some earnings power that we could start to see play out in Q2. So I am looking at crude, and I will be looking for opportunities. I'm going to watch that 20-minute opening range after the open to see if we get any kind of continuation of these trend days that we've seen recently. But for now, I think keeping an eye on crude oil is an interesting area. And similarly, with Natty, I'm not as bullish. You all may recall in mid-April, I got quite bullish on natural gas, about doubled from there. No joke. And then I started to get a little more concerned recently because we're still well above the 5-year max storage range, which tells you there's a lot more supply than demand. Hot summer will help with that a little bit. Bringing manufacturing back on shore will help with that to some degree, but really we need to start exporting LNG en masse. And this natural gas storage range is probably something that doesn't really resolve itself till later this year. So I think we got the easy swing trade out of natural gas for now. The path of least resistance is likely lower. So similarly, watching for how that shapes up on the 20-minute opening range, we may get a continuation of the downward pressure in natural gas. Gold is trading in a range. I'm not particularly interested in gold here in terms of the way that it's trading. So when I'm trading things on a day trade time frame, I'm looking for opening range and momentum, but I'm also charting it out on longer time frames, right? So if I'm approaching gold, I'm looking at this chart and saying, boy, it looks trapped. There's really nothing here that gets me very interested in wanting to trade gold. Now, if it pings 2,300 and change and starts to bounce, maybe you get a little bit of a pop to the middle, maybe like a 50% retrace, or maybe even a move back to the top of the range. But what would really get me interested in swings and even momentum-driven day trades in gold is a break below or above this range. That's what I'm really looking for. Either a break to new all-time highs, which seems less likely with a strong dollar and rising real rates, or perhaps a breakdown, which could lead to a quick $110 move lower over several trading sessions. That's the more likely scenario, but I need to see price agree. So for now, not super interested in taking day trades in gold. I'll be watching it, but I won't necessarily be trading it quite as much. And let's talk about Bitcoin a little bit, trading at just under 63,000 pre-market here. This is one that we had been talking about a bit on MacroVisor. Last week, I talked about 58,000 and change could be a near-term bottom. We got that head fake look below, was rebid pretty aggressively. We're starting to see crypto look a little bit more constructive here, though there's some resistance at that 20-day moving average, and I don't really like that breakdown from that prior trend. So there's a lot for buyers to really prove here. We can also see the momentum indicators are getting closer to neutrality, but they're not constructive yet. So like gold, this so-called digital gold also trapped in a range, a much larger range, albeit around $11,000. But until it breaks below or above that range, it's really just sort of pinging and ponging. Now, the more it knocks on the downside of that range, and it's not quite a bit, the more likely it is to break lower, just like the more it knocks on the upside, which it has quite a bit, the more likely it is to break higher. So these ranges, what I like to look at them as, it's like a coiled spring. It's building energy. As that energy is built, it will eventually be expressed. And the way it gets expressed is the continuation of that momentum after we build acceptance either above or below these key levels. So for now, not super interested in trading Bitcoin on a day trade or momentum time frame because those chop zones tend to be kind of violent. There's a lot of head fakes. So I'm really looking for that confirmed break to put the odds in my favor. Checking in on 10-year note futures because this has been something that's on everyone's mind lately. We actually got a decent rebid from the European session into the pre-market as we approach the open, just about 16 minutes left before the bell rings. There is a little bit of iceberging on top. There is some supply, some passive selling going into this. And of course, we also have that event vol catalyst with Jolts coming in just under an hour. So that could move rates a little bit more. But for right now, looking at bond yields, 10-year rates are down just about 5 bips here to 4.428%. And remember, my line in the sand's around 4.5%, so we're still below that. Let's take a look at the NASDAQ as well. It's been a choppy session overnight. We are seeing a little bit of a bid come back from the lows. Nevertheless, the tech-laden index is implied to open down about 0.4% on that cash NASDAQ 100 index. Now, I'm going to just bring out a chart that that I had from my weekends navigating the markets for TraderAid on the S&P 500 futures, because this is a pivot level I'm watching, and it's very much related to sort of everything we're talking about here. As when we look at day trading, a lot of these things are defined by longer time horizon moves that give us opportunities in shorter time frames. So I'm just going to bring up this chart of the S&P 500 on a daily time frame and say that my pivot level for this week is 55.1650. I'm much more inclined to take shorts below that level. And it looks like we're going to open just below that level. So I'm going to watch that 20-minute opening range. I want to see what kind of actual range we get, because that gives us a sense as to how much price may move in the day, sans any outside event volatility catalysts. If we build acceptance below 55.1650 during regular trading hours and we get a decent opening range with a break lower, I'm going to be very inclined to want to lean into shorts on a day like this, because I feel like this consolidation is getting top heavy. It's starting to tell us more and more that it wants to explore this lower volume node below. And if it does, and it's really building acceptance down there, I can see us moving down to just about 54, 54.50. I'm not going to get too aggressive and look for the move all the way below, on a day like this. I think we could get just a decent little drawdown, and then maybe we start to chop in this zone a bit and then maybe build for another move lower. I do think the risk is more to the downside than the upside today, but Jolts is going to be really important to that. So if I do start to build into a short, I'm not going to go full position until I see how that data prints and what the market reaction is. So we can see if we go back to ES, we're just kind of chopping around that level. Point of control is below us. VWAP is below us. So let's see how we do at the open. It's just about 13 minutes away. But we'll be watching these levels and getting a better sense as to whether we have a bit of an edge for that intraday short thesis. And folks, while I'm doing this presentation, if you have any questions about anything you see on screen, whether it's related to Bookmap or how I use it or how I've configured it, please feel free to ask. I'm more than happy to discuss these things. I want to make sure this is something that everyone watching can gain some value from, whatever your experience level is with trading or with Bookmap specifically. Just going to check on some of the news as we approach the open here. One other thing that we saw that was interesting yesterday was a spike in bond volatility, the move index moving higher, and sometimes, not always, but sometimes that can drag the VIX higher as well. Now, the move moved up to 106.23, up about 7.75% yesterday. Remember, it's been as high as 140, so this isn't necessarily a huge move higher, but it's noteworthy to see volatility pick back up in rates. We can obviously see volatility picking up in currencies, particularly the yen. It's been the talk of the town, and I think that's important, and it relates to rates, right? But also, volatility doesn't tend to stay contained in a single market. It tends to move around and shift and spread, right? So if we do see rate volatility and currency volatility increase, it would be reasonable to suspect that we could see equity and commodity volatility increase as well. So someone asked, I know Bookmap displays this way because around contract changes, but curious if there's an exact reason. So just talking about that liquidity. I'm just responding to them on text to tell them, yeah, it is quite unusual. But someone else asked, did we look at gold? We did, but I'm happy to bring it back up just to reiterate my view here that it's sort of in my no-touch category for now, because it's sort of figuring out what it wants to do. And a market that is in that state of consolidation, it's as I was saying, it's a bit of a coiled spring. It's building energy, right? Sort of coiling up for its next move. The longer it coils and the larger the range, the bigger the move likely is. At least that's based on my back testing of these things over time. So you can see gold has been coiling and coiling and coiling for really about 3 months. And we've been in this range, right? I don't really have a lot of interest in taking swings or day trades on gold unless we meaningfully break above or perhaps more likely below this range. A break below 2,340 cents gets us to 21.90.90. That's just based on me looking at price action, volume profile, and really getting a sense as to what the move may be from here. And a move above this area, it could get us maybe about a 50% extension from what the range was. So if this is about a 130-point range, maybe we get like a $65 move if we break above the top of that range is sort of the start of that. But for now, I'm just cautious on gold. I don't like that real rates are moving higher, that the dollar is moving higher, that there are other areas of long duration risk like Bitcoin that are sort of rolling over a bit. Everything tells me it's a little more risk off in precious metals in the near term. Over the intermediate to longer term, I'm still constructive on gold. And in fact, we'll be talking about that a little bit more in our Q3 outlook at MacroVisor when we kind of look over the whole quarter. So expect that presentation. There'll be a lot of free content for everyone to enjoy with that longer term outlook. But gold, silver, copper, platinum, I'm cautious on for now. I think we've had a great run in some of these. I think the consolidation and even a corrective phase makes sense. But over the longer term, I'm pretty constructive on all of them. Yeah, you're welcome. And someone DM'd me on the Bookmap Discord saying they're not able to hear the stream, but I'm pretty sure I'm coming through okay. They're also saying they're not able to write in the text channel. So there is a text channel here. It's a little bit above where the stream is, so I'm just going to pop that in the stream chat. So that way y'all have that. If you have any questions, you're able to pop them in that room, or you're welcome to DM me, whatever you feel comfortable with. There are no silly questions. Just about 6 minutes away from the US market open here. And folks, another thing I'll say is if you're curious kind of how I have Bookmap set up and why it may look different than what yours is set up to be, check out my last 2 streams. They're still archived on the Bookmap YouTube and on my YouTube under live streams. And you can kind of get a sense. I walk through for really like the first half hour how I have my Bookmap set up and why I have it set up that way. Now, obviously, my setup might not be ideal for you and your trading style, but it also may give you some ideas as to how you may want to configure it. I'm kind of aggressive on how I've customized everything, but that's because it's really helped me get a clear picture at a glance as to what's going on. And that's my whole kind of focus, if you will. I want to be able to have audio alerts that tell me kind of some of the more important turning points where I should look at charts. So I've got those set up at certain thresholds for unusual activity. But I also want the visuals to be something where I can look and, within 5 or 10 seconds of examining what I'm seeing on the screen, get a sense as to what that might mean for any of these assets. Because as you can see on the top line here, I've sure got a lot of instruments up there, right? You can, in the way I have mine set up right now in the current license, I can have up to 20 instruments. And I take advantage of that because one of my key themes is intermarket dynamics. I really think it's important to get a sense as to how things interplay with each other, like the relationship between rates and currencies and equities and commodities. There's a lot of interplay there, and sometimes there's opportunities to see a signal in one and explore how it may play out in another. So currently we're looking at S&P cash at about 54.57 ahead of the open. There is a pretty large gamma level at 54.50 that's likely worth watching. And that delta looks like it's about 58 points now, just for those that track such things, between ES and SPX. So give me a moment. I'll bring this gamma chart on screen so y'all can kind of see what I'm talking about. In fact, I'll bring 2 of them on so we can have both just as reference points. All right, so here is the naive model we have. Let's zoom this in a little bit and see if we can make it full screen. There we go. This is a model that's coded in Python that I've been iterating and improving and, kind of trying to make its inferences as accurate as they can be. And to the credit of the model, it's pretty spot on to BofA's and Goldman's and some of the other bigger firms, Nomura's. Their models and their gamma flip levels are usually within just a few points of mine, if not right at the same level. So why do I mention all that? Because we can see right here, 5450, this is a pretty big level, both open, call, and put inferred positioning, right? So that means that that could be an area that's a bit of a magnet today. It could also offer some degree of price support. So that's something to watch as well, particularly as we see the flows come into the market. Yesterday, S&P spot closed at 54.75. That's why you see that line kind of right there in the middle, that red line. And up above, you can see there's pretty decent ceiling, especially of calls. Calls in excess of puts at this level. So that can be a bit of a resistance level around 5,500. So now let me just open the next chart I have. Here is the gamma flip level. And you can see that we're set to open below that. That gamma flip on SPX cash is 54.71 if you're taking notes. And the further we move below that gamma level, the more likely it is we see an increase in volatility. So with the open implied as it is, and that open happening in just under 2 minutes, it is likely to be a choppier trading session for all the reasons that we've been discussing. Negative gamma, lower liquidity, holiday shortened week, rates that have pushed higher, which tends to have a relationship with vol as well. And then we have some event volatility catalysts today, like Powell and Lagarde speaking and Jolts jobs data. So these are all things to kind of keep on our radar. And you can see liquidity actually kind of diminishing a little bit ahead of the open here, perhaps because we have that speaking engagement, that central bankers forum in the European Union. And, market gets a little bit concerned about what these folks could say since there's so much importance now. I am old enough, and I'm dating myself quite a bit here, to remember a time where markets weren't so hyper-focused on every single word central bankers were saying, and they weren't constantly out there saying these things. It was a better time in some ways. Market open is imminent. Order book depth, 44,000 contracts on ES. You'll note I like to see it around 60,000 to feel like it's reasonably liquid. So in my experience as a trader, when it's quite a bit lower than that, if I'm going to take trades, I'm going to be more discerning about entry. I'm going to have to use wider stops because of the heightened potential for more whipsaw price action. And that means I have to use smaller position size because I'm taking greater risk. And I'm going to bring the ES aggression indicator just into the fore here. This is based on volume pressure from Market Pulse, and it's just sort of customized for the way that I've tested it to work best for finding aggression by buyers or sellers, and that'll show up in the subchart as well. So ding, 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 market is open, and you can see liquidity conditions still pretty poor. We'll give it like 10, 15 minutes to see how this shapes up. We've also got the options visualizer on screen to show some of these areas of positioning, and when volume starts to pick up, we'll see where they're transacting as well. And we are seeing some buying aggression here just at the open. Some of these smaller traders, more momentum driven traders, seeing some buy stops out in a short positions taken pre-market, about 137 contracts bought via stops. Also, some passive iceberg, nothing too noteworthy on either side, but still interesting. Now, remember, I like to look at the 20-minute opening range. So we are seeing that pressure continuing in the S&P, although it's not, there's not a lot of conviction behind this trading. You can see that in the size of these delta bubbles here, and we'll zoom in just a little bit more to the microstructure of what we're seeing here. It's also a thin order book, so it does not take much volume to move price around more. That's the other sort of leptokurtic distribution of risk in a day like this. Less liquidity has a correlation with higher volatility. And you can see this is why I like to watch the opening range and also have a pivot level for kind of discerning where my bias is going to be. Right now, it's rather neutral because we're sort of in the core of the S&P consolidation zone. So I'll bring that chart back up. Give me a second to kind of bring on screen what I want to show you all. But if you weren't here earlier, what I'm looking for if I want to get into a fade trade today is a move below 55.1650, right? That's my pivot, and I would want to see that move happening kind of as a part of breaking below the opening range. If we're given that kind of opportunity, then I'd want to lean into a short. And I really be interested to see how we trade in this low volume node, because in these areas, this is more of a decision zone for the market to determine where the auction's going to go. Sometimes you'll see these sort of look belows and bounce right back up like a beach ball. Other times, though, you'll see us build acceptance and move rather sharply lower. And I'd be more inclined to see that type of scenario today if we get that kind of 1-2 punch. 20-minute opening range breakdown that leads us below 55.1650. That have me leaning into shorts, and I'd be looking to watch how price behaves in that low volume node. But ultimately, my downside target could be as aggressive as 54.50. And it may take more than a day for that to play out. So like a gentleman, I would close that position overnight in my day trading account and go back in tomorrow. But in my swing, I would be taking a short position that I would hold and manage risk accordingly, stopping out above that same pivot. So just a little bit of context. And just a bit of a reversal of that earlier pop. So we're just going to zoom out, and you can always change what frame of time you're looking at by either kind of scrolling in and out on the timeline, or you can use time slices, just depending on whatever is more convenient for you. So we'll just go back to a 30-minute time slice. You can see that initial pop getting faded just a bit here. Again, we're watching that 20-minute opening range form. Now, one thing I like about this so far, it's not a terrible opening range. You know, it's about 11 handles so far. Maybe that can widen. Maybe we can have a decent amount of volatility and maybe even a trend day. Let's not get our hopes up too much, but anything's possible. What I don't like, however, is we're not seeing liquidity really come back to the order book. It's still only about 47,000 order book depth, which is quite low, and it promotes higher realized volatility, choppier trading conditions, greater potential for slippage, particularly around event vol catalysts, which we have coming right up at 10 a.m. with Jolts, and we also have central banker chatter happening as we speak. Now, the market on open imbalance was pretty negative, but nevertheless, we did see that big pop. That's one of the reasons you can't always look at that market on open imbalance for any sign of directionality, because while there might be these orders that need to be completed, what really matters is what happens with the actual flow rather than what the inferred flow is based on some of the limited data we have from those pending orders. Now, we are now actually starting to push right into that gamma flip level. We talked about that a little earlier. If we're able to build acceptance above there, we get back into that positive gamma regime. And that's one where price action tends to be more constructive. And saw a pretty decent passive buy iceberg come in there too. 1060 contracts on the buy side. That pushed our radial up as well on the lower right-hand side. So far, just a bit of a stair-step pattern higher. And we are getting some headlines from the speaking engagement. Powell saying we made a lot of progress on inflation. Disinflation trend shows signs of resuming. We continue to have solid growth, a strong labor market. The data represents significant progress. We need to be more confident, however, before reducing policy rates. Need to see more data like we've been seeing recently. So he's again kind of leaving the door open, as he likes to do, saying, you know, we're making progress. It looks good, but there's still more work to do. So I would be cautious about penciling in any rate cuts in the July meeting. There's none in August. It's more Jackson Hole, which is a time for the Fed to kind of talk more about policy and where it sees policy going. And then, you know, we get that September meeting, which I think September or December, we may get a cut. I'm a little leery of saying we get 2 cuts this year. It may just be 1. It all depends on kind of the direction of the data. But with gasoline coming back up as much as it has in June, and gasoline accounting for 70% of that softness in headline CPI on the last reading, the next inflation prints may be a little bit more hot than what we had seen from May's data in the June prints. And we continue to see that upward pressure building in the S&P, really reversing that pre-market action. We're now just starting to push closer to positive territory. The NASDAQ's up, well, it was up 0.05%. S&P is about flat here. Let's take a look around some of these other markets here as we build these opening ranges. We see crude moving lower, right? And we've got a pretty decent amount of volatility kind of coming into this one. We'll be watching this. Again, I want to see how the 20-minute opening range shapes up. So far, it's widening, as we can see with the price action. The NASDAQ really just rocketing off that open. We saw a little bit of buyer exhaustion, but it didn't seem to matter this time around. There's just a big concerted push. Let's go into some of the NASDAQ stocks and see what's going on. So Apple had a nice pop off the open after that drop. We'll go in alphabetical order of the Mag 7, so to speak. Amazon just sort of chopping sideways here. Google also not really joining the party here. I'm going to have to imagine NVIDIA, Meta, yeah, some of the usual suspects of the Fantastic Five kind of adding to this, and Meta making new regular trading hour highs. Microsoft chopping, but largely constructive, getting back to those recent highs. And NVIDIA, as suspected, sort of rocketing higher, reversing some of what we saw yesterday. And Tesla, even though their delivery numbers were a continuation of soft, slowing sales data, we are seeing still a bit of a bid in this one. Let's also take a look at Bitcoin. Bitcoin's looking a little bit constructive here, bouncing off VWAP twice, so maybe setting up for some decent intraday scalps with a more positive bias. But again, as I showed on that chart earlier, I'm a little bit leery because of the range we've been trading in. I really want to see a break above or below that range to get more constructive on trends, especially on a swing time frame. So we'll bring it back to S&P. And again, the opening range is getting more and more interesting here. Look at this. We've got now about a 20 handle opening range. We haven't seen something like that in a while. Could make for a pretty interesting day, and maybe, at least with the way things are shaping up so far, a positive trend day. Let's see what happens. Powell goes on to say the risks are becoming more balanced. We have the ability to take our time and get this right, kind of indicating again that rate cuts not necessarily forthcoming on the timetable the market expected. Remember, we came into this year with the expectation of 6 or 7 cuts, and that was wildly out of bounds. And I had been pretty adamant about expressing that being wildly out of bounds, and expressing it not only in opinion, but also in trades when momentum lined up with it, fading 2-year note futures and really looking for rates to move higher on the short end, which they have quite a bit. And that's something that I think that, the macro meets momentum strategy, particularly on a swing time frame, is something to take into consideration for one's trading. So far, we are seeing just a little bit of a retrace of that move. We're seeing some liquidity build below, right around that inferred gamma flip level as well. Liquidity in the order book still remains somewhat low, around 48,000 contract order book depth. So again, that distribution of tail risk on even an intraday basis means if I'm going to take a trade, it's going to be smaller size because I have to use wider stops. Lower liquidity usually leads to higher realized volatility, choppier trading, more slippage potential. Now we're going to zoom back in just a little bit more. One of the cool things about the way this software works is you can really get very granular with it. You can see things on time frames that most of the time we don't even really necessarily appreciate in our day trading. I mean, look at how you can see the second by second tick data. I think that's pretty darn cool. And you can see the liquidity kind of as it's coming in and where it's leading us. So that's another thing that can be pretty fun. Just if you're scalping this thing and you're really kind of getting a sense as to how the book is trading, zooming in and then being able to zoom out, seeing multiple time frames on the same screen it's pretty helpful overall. We do see a lot of liquidity building above here. It's not quite what I would constitute a death cloud as. A death cloud is where you have enough overhead liquidity that it could pose a serious barrier, right? Act as a resistance level. It's not quite that much. It actually looks a little more constructive in that sense, giving it the market more of maybe a positive bias to kind of push into that liquidity. A illiquid order book in that sort of three-way auction almost provokes price to seek liquidity and release it. And so when you see liquidity building above it, to me, it suggests you could see a bit of a push higher into that same liquidity. Excellent. Glad to hear that you're able to hear now, Skrilla. And we are starting to see some of that options trading data come on screen with the options visualizer. So the most active call strike is quite a bit above price. And the second most active call strike is just about where price is now, right? And that's processing. So sometimes it kind of will be unavailable for a moment or two. But it's interesting to see that activity coming into the fore because it does tell you there is a bit more of an upward bias, at least in the initial data coming over the CBOE. NASDAQ also just really kind of has that look of going straight up. You know, we're seeing a little bit of settling here. We also just saw another buyer exhaustion print here. Perhaps this one will be a little bit more meaningful. But that also was accompanied with a stop out. So that was forced buying. That was a bit of an exhaustive move that we've seen so far. We'll see if that kind of registers with the price action, if we get just a little bit of a pullback and a consolidation before we push higher. But those buyer exhaustion prints, they're based off of extremes, aggression on one side. And so seeing that is always kind of interesting. You know, and we see that print gaining a little bit more confidence up there as now we have another circle in that column. And to be clear, this is an indicator that I created that's it's in a more, I guess, beta experimental state, but it's a lot of fun to build this sort of stuff and to see how it plays out. You could see, look, that buyer exhaustion print seems to have been meaningful as we're tracing lower. So let's zoom in just a little bit. Yeah, that buyer exhaustion was a decent signal indeed. So when you see those exhaustion prints, the way that I handle them is I look at it as a heads up. I need to see price action follow. And then I think that it can be more of a tradable event. So we did see that move lower and we made a new low on the microstructure and then we consolidated and made another more meaningful new low. You can also see sellers are somewhat aggressive here. So these prints can be helpful to give us a sense on a scalp time frame where price action may be going. We just want to see a little bit of confirmation, and usually that happens within about 3 to 5 minutes of the print. And then if it does, it can set up for a decent tradable scalp event, right? We are about 8 minutes away from Jolts data, though, so I wouldn't get too sized up into anything because that event vol catalyst on a illiquid day like today could move rates and markets quite a bit. especially if there are any kind of outliers in that data. That is to say that it comes in hotter or colder than expected. And recapping from earlier, right now, Jolts job openings is expected to come in at 7.95 million. That'd be about 100,000 less than last month's print of 8.05 million. And so if I was trading off that exhaustion print, I would cover into this resumption of buying because, decent little scalp, but at the same time, this is a very short-term signal and you have to see price agree with it. And now we're seeing buyers get more aggressive. So I would want to cover and, we'd be able to get a little bit out of that move. And, sometimes these lead to broader trends forming as well. Speaking of trends, we have formed our 20-minute opening range, right? It's a decent opening range, somewhat chunky, about 21 handles on the S&P. So now it's a matter as to whether we build acceptance above or below this range to discern whether or not there's a higher probability of a trend day today. Those are trades that I like to take more on a hour plus time frame, the trend trades, right? If we get a decent trend day, typically that's something I'm going to put a bracket order in for, and I'm going to sort of set it and forget it as I work on other things. Because I don't need to micromanage, every single order. I will micromanage my scalps, particularly something that's from an exhaustion indicator or something like that, because it requires more real-time eyes on price action. But if I'm trading a trend day, I'm just going to manage my risk and reward and set it and forget it and look for other opportunities and kind of continue my work. And the reason I say that is I see a lot of day traders get burnt out thinking they have to stare at the screen every second of every day. It's not true. Depends on what you're trading, what size you're putting on, and how you're managing your risk. There are some strategies like trading trend days where you don't necessarily need to be hyper-focused. The other thing I would say is if you feel this pressing need to be glued to your screen, and it has to do with this nervousness about the amount of risk you have on, then you have too much risk on. If you feel like you just have to kind of watch every single little thing and it affects your pulse and your blood pressure, you've got too much risk on. Remember, trading is a business. It's not a game. It's not a casino. And the goal of a business is to have enough capital to keep opening up the next day, next week, next month, next year, which means risk management is paramount. Having a systematic approach to trading is paramount. Going on gut feel and emotion is how you hurt yourself. Revenge trading is how you blow up, right? None of that stuff makes sense. If you want to be consistent, you need to know where your risk and reward is before you even get into a trade. And you should journal those trades so that when you look back at what worked and what didn't, you have a sense as to what kind of trading comports with your personality. We're all different. If you're interested in learning more about the psychology of trading on my YouTube, I have a video on it. It's about an hour long. It's well worth the watch for folks of all skill levels. If you're wrestling with these issues of kind of managing your psychology, your position size, being more sustainable. I think the psychology of trading, because ultimately, unless we're all driven by, algo trading, there's a huge psychological element. Perception governs like 90% of our view of what's happening. And that's largely a matter of psychology, how we're wired. And the good news is, even though we're all wired differently, there are various trading styles, asset types, etc. that can comport to our personality. It's a matter of finding what works best for us. Can't follow me or someone else blindly and expect that to be a perfect system for you. You've got to figure out what works for your psychology, what works for your goals, how much risk you really want to take on, and then kind of iterate that system. So there's every reason to have a community. I think having a community of traders to exchange information and knowledge and learn from and share with is great, but we also have to respect the fact that this is a very individual journey. No one's going to care more about our finances than ourselves, right? We are ultimately responsible for our gains and our losses, as well as learning why they're happening and building a system to improve our consistency and discipline so we can maximize that, so we can become successful traders, because this is not an easy game. It's not. A lot of people fail. And if you're struggling right now, I feel you. I understand. It happens. You can take a break. You can come back to it. But the biggest thing you need to figure out is why. So you can overcome that milestone. And a lot of the folks that I talk to, that I coach, it's psychology. So we're just pinging that gamma flip level here on ES. Got that chunky 21 handle opening range. Maybe we get a decent trend day out of this. Liquidity is still low. It's getting a little better, about 50,000 on the order book depth, right? So it's not quite as, you know, kind of like crickets as it was earlier, but it's still somewhat low. Again, I like to see it around 60,000. So in an environment like this, one of the ways I manage risk is I look at liquidity conditions. I infer from them, based on backtesting and studies, that low liquidity tends to mean higher potential for realized volatility and slippage. And I will take a smaller size and I'll be more discerning about the trades I take on because I have to use a wider stop, right? So the amount of risk that I take on with a stop actually determines the size of the position I'm going to take. And that helps me manage my risk because then I already know exactly what my drawdown is going to be before I go into a position if I have to de-risk, right? I also have a sense as to what my reward will be, and I calibrate accordingly. I need at least 2 to 1. If my reward isn't expected to be potentially 2 times higher than my risk, I don't even want the trade. What's the point? That's just like tossing a coin and, you know, or going to a blackjack table. I want the odds to be on my side, which means I'm a little more discerning. That's why I like to have an opening range that leads to a trend day where there are rewards that exceed the risks. Then I feel more comfortable putting in that trade, right? So I'm not your typical scalper. I'm not looking at every micro move. I'm looking more for, you know, moves that give me comfort that I have a trade where my risk is significantly less than my reward. I express a lot of those trades on swing time frames, but I day trade where I see the opportunities as well. And we've got Jolts data coming up in just over a minute. I'll stay on for just a few minutes after that, just so we can watch the reaction and discuss it. And again, the floor is always open. If you have any questions, please put it in the chat room. My goal as an educator is to help you all gain an edge in these markets. The odds are against us, but they don't have to be. Fun fact, almost anyone can become a trader if they're willing to put in the work. It's not easy money. It's not just, you know, lottos and Lambos. It really is hard work and discipline to get good enough that you can stay in this game and grow and prosper. But if you put in the work, you can be a successful trader. That's the key. You're not going to hear that on a lot of the sort of, you know, social channels where people are talking about, oh, I just made 10,000% on a call, et cetera, and acting like there's some consistency and system behind that. There's not. It's pure gambling most of the time. It's really about building your skill set and becoming more consistent. And again, just about anyone can do it, but you have to put in the work. That's what separates the traders that I see in this game for years and decades from those that kind of burn out and blow up. Jolts data is imminent. We can see liquidity thinning out on the order book. Now 42,000 order book depth. It's gotten pretty dark on the heat map as well. We do see a large resting offer overhead. And that data should be printing now, just waiting for it to come over the wire. Okay, so we got actual 8.14 million. Actual 8.14 million. That should push rates higher, and that could be a bit risk off. You do see a drop here in 10-year note prices, which does imply a bit of that risk off scenario as well. You could see that as a reaction to the data. We're getting kind of a rally back to where we were before, but nevertheless, the initial knee-jerk reaction to that data was a little bit of a sell. A stronger jobs market gives the Fed more cause to keep rates higher for longer. That's one of the reasons this could be interpreted as somewhat negative. So we'll see how we trade from here. I like to give it a few minutes for the market to digest because the knee-jerk HFT move, parsing the headline, may not always be what the market does. And there's reasons for that. Sometimes algos overreact and their handlers have to kind of come in and undo whatever trades they put on. But we are seeing a resumption of some of that downward pressure. We are kind of building some acceptance below this point of control that was earlier dragged up by buyers. We'll see where this goes from here. But I think that the same plan remains intact, right? And that is that if we build acceptance below 55.1650, I'm more inclined to want to take shorts. You can see this is a point of control level that we're seeing resistance at. It goes back pretty much all the way to late May. So this is a really important level we're trading under right now as a resistance level as well. But I think that the real opportunity for swings and larger fades is if we build acceptance into this low volume node below 55.1650, then I think we have potential maybe over a multi-day time frame to trace back to 54.50 on ES. So thank you everyone for tuning in. Really appreciate it. It's been me, Markets and Mayhem from TraderAid, talking Bookmap back to the futures. And I'll be back next Tuesday at 9 a.m. Hope to see you then.